Well, there's a problem. When the yield curve is sloped like that with short-term interest rates higher than long-term interest rates, that reflects an expectation in the financial markets that monetary policy is going to be eased, that the economy is going to go into recession, that inflationary pressures are going to bucket off. Well, hello again, everybody. If you've been reading my material over the past 18 months or even looking at these weekly videos a few times over the past year or so, you'll know that there's been this particular environment I've been warning about coming along, and that I would be repeating something I wrote first of all back in 1998 and then again in 2008. And what I wrote back then was, do not touch the 5-year fixed mortgage rate with a barge pole. And the reason I wrote it back then in 98 and again in 2008 was because we saw the development of the relationship of the mortgage interest rates, where the 1-year fixed rate was going up, but the 5-year fixed interest rate was coming down. And so it became cheaper to fix for 5 years than to fix for 1 year. And a lot of people went, well, that's pretty obvious what I'm going to do. I'm going to fix for 5 years. Well, there's a problem. When the yield curve is sloped like that with short-term interest rates higher than long-term interest rates, that reflects an expectation in the financial markets that monetary policy is going to be eased, that the economy is going to go into recession, that inflationary pressures are going to bucket off. And it's starting to happen again right now. What we've seen in the financial markets is that the 1-year cost to a bank of borrowing money has been pushed up quite a bit over the past 3 to 4 months by the high inflation number on October 18, and then the Reserve Bank's scary words and rate rise of November 23. But at the same time, we've seen an increasing frequency of weak economic and inflationary data in the United States in particular, and that's led to the longer term interest rates coming down in the US here and pretty much everywhere else. We've also seen some fairly shocking results for New Zealand business and consumer sentiment, hiring intentions, investment intentions, etc. All things that basically say the outlook for the New Zealand economy is weak. And if there's one thing we economists know, is that eventually, you're not going to get your timing right, but eventually a weak economy is always going to depress your inflation rate. It's going to go down, and that's what the Reserve Bank is seeking. And once they can see the inflation rate going down and that they can become pretty certain it's going to get towards 2% or so, they'll start cutting their official interest rate. Now at the moment they're still going to increase it further from 4.25%, but the stuff that we economists know is going to happen, we can start to see it happening in the background, and it's finally manifest itself with at least one lender so far increasing their 1-year fixed mortgage rate a bit further, but cutting their 2, 3, 5-year fixed mortgage rates, so the yield curve is inverse. And now here's the problem. Now, the banks, they all want to lend more money. Obviously, at the moment, they're not meeting sales targets because house sales are falling away quite strongly. So they're looking for where they can cut interest rates to get some advantage. The cost to them of lending long-term fixed has gone down, and so they're cutting interest rates out there. And so you're thinking, oh, maybe I won't fix at the expensive 1 or 2 year rate. I'll go for 3 to 5 years. Well, unfortunately, this is basically the worst time in the interest rate cycle to be fixing long. This isn't the environment of 2 years ago when I was saying if I were a borrower, I would fix for 5 years. When the rate was 2.99%, it was a record low. It was a complete no-brainer. Well, with the rates now for fixing 5 years at sort of 6.5%, 6.8%, it's quite a different world. And the yield curve relevant that we economists look at is saying the Reserve Bank is going to win against inflation eventually. It may not necessarily happen in a shorter time period as we think, but the interest rates will be coming down. Be very careful. You're looking at your mortgage rates at the moment. You're going to think, oh, it's going to be cheaper with some lenders, and probably all of them within the next few weeks, to fix long as opposed to short. Some people will have to do it for cash flow reasons, but just be very aware. If you jump now from fixing 1 year or so, 2 years, out to 3 to 5, you're doing it near the peak in the cycle for these interest rates out here. And come 2024, 25, you could be ruining that decision. So, I'm not giving personal advice here. It's just take into account that the yield curve slope going down like that is signaling interest rates falling away at, an uncertain stage down the track. If I personally were borrowing at the moment, I would take the pain of fixing 1, at most 2 years, and look to benefit from eventually when monetary policy is easing. But basically, the game is afoot now with this don't touch 5 years with a barge pole scenario, but it doesn't all happen sort of straight line, and it may take a while before the bulk of lenders have actually got interest rates like that. And like I say, for some people, you're focused on the worst case scenario, so you simply want the protection of fixing long, and at least you know what your outgoings are going to be for the next 3 to 5 years. So I'm not poo-pooing that entirely, but just be careful. You'll be fixing near the peak in the cycle for the 3 to the 5 year rates. Good luck.